Holy bleep. It's Tuesday, October 26th. I can't believe it. Halloween coming up. This is the macro setup. I'm Guy Adami. I'm joined as always by my dear friend Dan Nathan. Today's episode is being brought to you by our presenting sponsors, plural. IGUS, one of the fastest growing forex dealers in North America. And oh, by the way, backed by popular demand, we're going to be joined by the great DANIELA SABIN HATHORN, market analyst with IG. And of course, our other presenting sponsor, the guys and gals at Open Exchange, because Dan, they manage virtual meetings that matter for the top companies around the world. Yet again, I am geeked up. Market's never going down again. Dan, how are you?
All right, what was that that one candy that you used to take out of your kid's bag, Guy, when they got
Charleston
back?
Chew.
It was
Charleston
always, you would
Chew.
search in there for the Charleston Chews? Yeah.
Is that a bad thing? I don't know.
And I'll tell you this. You know what mine is? The Butterfinger. You know why? Because it's my wife's favorite. And I would go in there and I'd get them for my wife and I'd put them aside. There you go. Okay.
Butterfingers. I'm going to give you a hot take, and I'm not allowed. I don't know if I'm allowed to say this. Butterfingers suck. Nobody likes the people that invented Butterfingers. Don't like Butterfingers.
You're wrong.
Please.
Homer Simpson, huge fan. All right, let's do it, man. We got markets absolutely raging here. Runaway breakout. Our main man, Carter Braxton Worth of Worth Charting. Guys, check out his stuff. He's on the Twitter. Go to the website there. He does his charts every day. This tweet, Guy, it kind of knocked you off your chair a little bit. What does it say to you? Read it out for us. What does it say to you? It
encapsulates everything that's going on. The 5 largest stocks in the S&P 500. So the S&P 500 has 500 stocks. So 5 of 500 is 1%. So 1% with a combined market cap of $9.23 trillion represents 22.1% of the index, and they report earnings this week. Curiously, which is a difficult word to say, the other 6 times when these 5 companies reported earnings in the same calendar week, the S&P 500 was down for that week. Well, there you go. Carter just laid it out. But as we sit here, Dan, and we're going to look at a chart, that S&P 500 saying, no mas, Carter. You're wrong this time there, sucker.
Or
we'll see. There's a lot of time left, Dan.
Or maybe not. I mean, look at this. This is not a particularly great setup. You want to buy those names. You know, Microsoft powered its way back to its all-time highs before the S&P did. It was one of the largest stocks to make a new all-time high during that downdraft in September. So we're going to get Microsoft. We're going to get Apple. We're going to get Amazon. And we're going to get the Alphabet, Guy Adami. We have Facebook. It was already down into its print a little bit. Now it's down afterwards. I think it's down 17% or so. We're going to look at that one in a second from its all-time highs here. But this is not a great setup to buy a move like this, Guy. We've gone up, 7% in a straight line after the last 2.5 weeks. So those guys are going to have to put up huge beats and raises to get this thing going that much higher. So I like Carter's stat there a little bit.
Yeah, we played a game on Fast Money a few weeks ago. It's probably longer than that now. Choose your adventure, and Carter was sort of the crux of this. And my adventure was, I thought the S&P 500 would trade down to 4,100 and close the year significantly higher than the prior all-time high. Well, we got down to 4,270 or so, and here we are at 4,600. It's interesting. Carter brings up some extraordinary points, as always, but this S&P chart, to your point, Dan, it's getting a little ahead of itself, and maybe we're going to exhaust it on this week of extraordinary earnings. Let's take a look at our next chart, as they say, which you can't go from the S&P to then you have to look at the NDX. And this is not, Dan, validating some of the highs we're seeing in the S&P 500. And to a certain extent, a lot of it has to do, I think, with the letter F and B.
Yeah, there's a couple ways to think about this. So the S&P is already broken out and it's just kind of off to the races, or at least it feels that way. So here we are, the NASDAQ 100, where those same 5 stocks, Guy, that made up 22% of the S&P 500, they make up 45% of the NASDAQ 100, okay? So without them participating, it's going to be really hard to make new highs here. So like you just mentioned, the Facebook is down a little bit. Let's see, we got Microsoft today after the close and the rest of them. I guess what this chart says to me, though, about the S&P 500, the broader market, is that they're seeing good breadth, right? So the market, the rally is broadening out away from some of these prior leaders or these mega cap names. So I can see that as bullish. And I'll just say with both of these charts, that 50-day moving average that's gone basically sideways over the last 2 months, if you think about it right here, that should be support near term. That's just above 15,000 in the NDX. And then all the way down there, you see that lonely 200-day moving average, Guy Dami, that yellow line line here. It's also very near the breakout level from mid-June to new highs. So if there's any reason for the NDX or those 5 big names to go lower, and we should just throw Tesla in there, that crossed $1 trillion in market cap yesterday. So those 6 names to go lower from here, you're going to be sniffing 14,000 in the NDX in the not so distant future.
The great Roy Orbison sang a song, Only the Lonely. You mentioned that, but Facebook is feeling pretty lonely now. Let me stop here for a second, Dan, if I may. Last night on CNBC's Fast Money, when Facebook was trading either side of $340 post earnings, Melissa came to you and said, Dan, what do you think? And you said, my sense is that this will be negative by the opening tomorrow. And man, oh Manischewitz, Dan, you nailed that one. Here we are, smack dab right at the 200-day moving average again. That was a wonderful call by you.
Yeah, just a little bit of a trade school, and obviously I could have easily been wrong. The thing could have been off to the races, but when you have price action in the aftermarket before investors, large investors, are able to kind of digest what is a new earnings guidance, to me, I don't really put a lot of stock in those sorts of post-market moves. We know the liquidity can be really low, and if you think about it, that Q4 guide, despite the valuation, there's a lot of headwinds here, and I think if you're a large holder of this stock and you have been enjoyed gains for years and years, the story might be changing. The narrative might be changing here. So when I look at this chart on a 1-year basis here, I see that breakout level guy from the spring around $300. I see the stock now over the last few days just hovering on that 200-day moving average, getting a little lift here and there. But you tell me what happens. The more times you test that level, the weaker that support becomes. And I don't know, man, I'm kind of feeling like if it can't really bounce right here and make an attempt to fill in that gap from last Friday, you're going to be testing 300 in the not so distant future.
I think it was the outlaw Josie Wales, and you mentioned that the other day when they were trying to break this giant rock to get the water flowing in and just bang it with a sledgehammer over and over again. And at a certain point, that rock's going to break. I think that's your point. Well, you know what hasn't broken one way or the other is this RTY, which is effectively the small caps. And we've been, listen, it seems like I am a broken record because quite frankly I am, but this has now been sideways for the better part of 9.5 or 10 months in a very well-defined range. We're creating a bit of a pennant, I guess. We're going to break one way or another in a significant way. Now, if rates continue to go higher, people will say, you know what, rates are going higher because the economy's better. If the economy's better, the most economically sensitive names should do better, and that should lend to this RTY trading higher. I would sort of take the other side. But as they say, Dan, that's what makes markets.
Yeah, you just mentioned that if rates are going higher and this index trades higher with rates, it's because the economy is perceived to be doing better. I'm not so sure about that. If you think about some of the bottlenecks we're seeing in the supply chains, and a lot of people thinking that some of these price increases that we're seeing, whether they be in wages or other inputs, are here for a while, rates might be getting ahead of what they think the Fed policy is just dead wrong, right? And that might not equate to a strengthening economy. If anything, we knew that the economy in the back half of this year and into 22 would be decelerating based on some of the trends that we saw late last year. So to me, this one's tough. I suspect it remains range bound. If you were to break that long technical resistance level, well, you know what happens there, guy. That becomes support. As you would say, you start trading against that on the long side. I guess I'm just in your head, man. I've been sitting next to you for 10, 11 years doing this sort of thing. And we can just finish each other's sentences unless we disagree with each other. In this one, do you play for a breakout here? Let's get through Q3 earnings. Let's see the sort of visibility that U.S. corporations have here. And if it looks not as bad or priced in, then you play this one for a bit of a catch-up trade. In my opinion.
Well, you folks of a certain age might remember an artist named Dave Mason. He sang a song, We Just Disagree. You also may remember a show called what's that with Pick Me Monty? Do you remember that show, Dan? Pick Me Monty? No, you don't remember that? Door number one, door number two, door number three. Let's make a deal. Well, we did door number one. That was Carter Worth. Door number two comes in the form of David Rosenberg. Now, this headline is a bit hyperbolic because he is not a long-term bear. I think David Rosenberg does extraordinarily thoughtful work, but he was responding to a tweet from Jack Dorsey, the CEO of both Twitter and Square. Jack put out, hyperinflation is here, get ready. And he said, David Rosenberg said, those warnings are, and I'm quoting now, Dan, totally ridiculous. Thoughts?
I thought it was just a really weird comment here in a way. I mean, obviously Jack Dorsey is a huge Bitcoin maximalist. Okay, so if a lot of the existence of crypto in general or Bitcoin in particular was really meant to be an inflation hedge or a hedge against the degradation of fiat currency, well, hyperinflation fits that narrative pretty well. Jack is a pretty thoughtful guy. I think everyone who knows him would say that. This seemed just like a very odd comment. And listen, I'm with you, man. I mean, Rosie is one of the most thoughtful guys. Was he a little early and ridiculed for being early about calling the financial crisis in 2006 and 7? Yeah, man. But all the reasons that he identified were the reasons why we literally saw the economy come down to its knees. So I love listening to Rosie. I'm a huge fan of his, and I agree with this one. But I guess the point here, guys, what do you do if we even have sustained high inflation if it doesn't prove to be transitory?
Yeah, I mean, hyperinflation was a bit hyperbolic, but I mean, it all comes down to the US 10 years, right? I mean, that to me, this and the dollar are the two most important charts. And we traded up to, I think, 168, 169 last week in the 10-year, back down about 163 and a half, 164. I think rates are sticky here. And when I say sticky, I think they continue to grind higher. I think we're going to take out that 177 or so level we saw back on March 30th, I believe. And then we're off to the races in terms of yields. Again, I think I know what it means for equities, but doesn't mean I'm right. I think it's going to be really difficult for equities to rally in this environment if rates do go higher. Other people would say differently. They'll say that is economic strength and stocks should do well in that environment. We will see. But, hyperinflation, no. Inflation, yes, which means to me rates are going higher, Dan.
Yeah, listen, we have some sort of guide. I know that things are very different this time when you think of the size of the Fed balance sheet and the size of the quantitative easing that they're doing, that they're supposedly going to start tapering pretty soon. But back in 13, 14, 15, when the Fed were coming off that QE or tapering QE and contemplating coming off a zero interest rate policy, there was a good bit of equity volatility. And when you think about the concentrations that we have in a small group of names that have proven to be very sensitive to higher rates. When you think back to Q1 of this year, the NASDAQ went unchanged at one point in March when rates were very near their high because investors were moving out of some of these kind of recurring revenue models, these kind of more secure moats, if you will, and moving into more GDP sensitive names. They underperformed. They started taking off when rates started coming in. So to me, I do think that there is risk to the equity market, especially when you consider forward valuations at multi-year highs, decade-long highs. And when I look at this chart of the 10-year guy, we see that we drew this little triangle pattern here. It broke up to the upside. You see the converging 200-day and the 50-day. If it were to pull back, that downtrend where those converging moving averages makes a whole heck of a lot of sense. It looks like 142. But your question about what does it mean if rates are higher? What does it mean, guy, if rates go precipitously lower? Does it mean that we're having a bit of a growth scare? And then that would play into that whole issue of stagflation, which might also be hyperbolic as we're using that word in this little segment here. But this chart's pretty interesting. Let's see if we can get back to those March highs. Let's see how stocks act on the upside. I would just say stocks don't seem to be too bothered with the 10-year where it is right now. If we had to move 20 bips higher or 20 bips lower, that might be the reason either way for stocks to sell off.
Yeah, it's been interesting to see if and when what happens that when the 50-day crosses through the 200-day. But that is, we're not there yet. Dollar we have to talk about because, again, as important as yields are, the dollar is, in my opinion, equally important. We had that big move up to 94.5 or so in the DXY. I don't want to say we failed because we're still in that area, so we'll see. But obviously, we were rejected at that prior high back in November-ish of 2020. What are your thoughts here on the DXY, Dan?
Listen, this is a constructive chart, and I know that from fundamental reasons, Guy, you think it's going lower, and if you believe in the inflation story or the hyperinflation story, which again I don't think you do, then this thing is going lower. But you got a little back and fill here. You have a nice uptrend from the start of the summer here, holds the 50-day, test those prior highs again. You might have a breakout here. So to me, I'm kind of positively disposed on the Dixie right here, and especially if you think rates are going higher. But Guy, I gotta tell you, man, this one has turned into the widowmaker. On the flip side of that other sort of inflation hedge that doesn't seem to work when their inflation fears are at their highest that they've been in decades right here. The XAU, the gold chart. Here's a 2-year, man. It is in a well-defined downtrend. You see it right there. That 200-day at about 1790 or so. It just seems to be meandering, though. A series of lower highs here. You see the support just above what looks like to be a bit of a double bottom just below 1700. What do you do with this thing here, man?
You're coming at me hard here. I knew where you were going. I mean, I could hear it in your voice. You know, I threw a little stuff at you. You're throwing it back at me again. I love it. What does it mean? Well, look, gold's been extraordinarily difficult since last summer, August to be exact. I think it was what, Dan, August 7th when it traded up to that 2075 level, but it's been tough ever since. And it should work in this environment, but now the crypto's at $2.5 trillion, I think, market cap, industry, security, whatever you want to call it. Obviously, that's taken some of the fuel away from the gold move. I still think higher for all the reasons that I've talked about for months now, but it's very hard to make a bullish case for gold. Maybe Daniela can talk me through it when she comes on. But, you know, you're saying to yourself now, well, why haven't you mentioned crude in the first 15 minutes? Well, relax, people, because we're going to talk about door number 3 in a second. And what is we talking about? Well, it's Tom Lee, who's been a stud. FX Insight, Fund Strat. That's Tom, and he's been right. Now, listen, I know over the summer that OIH trade gave up the ghost in a major way, but it's back on its horse. He says stick with energy and stick with Bitcoin. It's hard to push back against that, Dan.
Yeah, if you look at crude oil in particular and that breakout that you've seen here, it's just on a runaway here, and that's one of the most constructive charts I would say that we look at in the macro universe here. And there's just some fundamental kind of tailwinds going on, and I think Tom has been all over that. He's been buyers on dip here. We also know that Tom is a massive Bitcoin bull, and he has a whole host of reasons of why this thing works in this environment. So when you look at the two of them, you know, I'm all in on the Bitcoin. Listen, I'm a believer. When I say all in, I mean you buy the dips. And the problem that you have if you're like me and you're just kind of crypto curious a little bit is those dips that you start buying, down 10%. That looks kind of like a good level. It could go down 20%. It could go down 40%. It was down 55% at its lows, from its highs in April down to its lows in the summer. That's a really tough dip to buy here. And I think one of the reasons why we label in the media, not we, me and you, but sometimes you see those headlines like of Rosie, longtime bear or perma bull, because they have people who stick to their guns. They have fundamental reasons for doing what they're doing. And I think Tom has them both here in energy and in crypto. I'm just more of a dip buyer in crypto. I think that, crude oil in particular is going to remain very, very cyclical here and probably underperforms many other macro assets over the next 10 years or so. So I suspect Bitcoin and other crypto coins or crypto assets will outperform. So I'm more in that camp, Guy.
We'll take a look at the crude oil. You mentioned Runaway. You would think I'd be a big Bon Jovi fan. I am not. I don't know. But Runaway, obviously one of their hits. I find that song just to be like fingernails on the chalkboard. Is that what the kids say? But you know what's Runaway here? Is crude oil. And I'm going to stand by this, Dan. I think you see triple digits by the end of the year. I'm not saying 150, but can it print 100? Yeah, I think it can. Here we are. We're through trend lines. We've done everything we need to do. I think, and this is just my opinion, I think the oil market is challenging this new administration. And I think they might make some policy errors in the form of releasing from the SPR. That's just my view. That's not the fundamental case here, but crude has been a very interesting chart over the last month and a half, 2 months, Dan, Nathan.
Yeah, I look at the steepness of that, breakout here and the move off of the lows in August. I see that, the level of the breakout here. And I'm going to take the other side of you, Guy. I'm going to say 75 before 95. How's that, buddy? I think we see a pullback back towards that 50-day moving average. I think once we kind of get back past some of these issues about the bottlenecks, and I do think that's going to abate a little bit. So that's just my quick take there on crude. But, I get it. It's been a great momentum trade, and buy the dips. I'm with Tom. FS Insight, buddy. It's
hard for me to say. FS
really
Insight. Let's take a look at the Bitcoin, please, because you mentioned your crypto curious. I don't even know what that means. I think I know what it means. You're interested in it. You find it fascinating. So you read a lot about it. But I guess the question is, have we made a double top, and are we going to retest sort of down to that 45,000 level, which is the 200-day moving average? That's really, I think, when the rubber hits the road, I think that's what a lot of people are trying to figure out. Not because they're going to panic. I think a lot of people, to your point, want to buy more if it gets there.
Yeah, and I think they have been buying more. And our friend Brian Kelly, he runs a digital asset investment firm, and he says the volatility is a feature. It's not a bug here. And so when you look at these charts and you see this back and fill sort of action here, you're kind of waiting after a move from 40,000 to 65,000 or 66,000 of new highs for a move on a pullback. Look at that consolidation level that we had just a couple weeks ago. It's probably about 55,000, and then the 50-day moving average down there at 51,300. I mean, if you get down there, that's where you start picking at this thing. I think you want to buy on pullbacks. You don't want to buy breakouts per se. I don't think you do, just because look at the way this thing comes in. And if you own it lower and you end up buying some on an 80% move over a short period of time, you're going to have to, that's going to be a tough way to average into something like this. It depends on your time horizon, obviously, but to me, I think a pullback towards that consolidation from a few weeks ago in the mid 50s, somewhere 54, 55,000, that's when I start picking at this thing.
You know what time it is? It's time to bring in DANIELA, SABIN, HATHORN. DANIELA, how are you? You've heard Dan and I musing about certain things. Before we get to your thoughts about Bitcoin and others, thoughts on what you've just heard us waxing poetic about?
Hey guys, well, I think I'm going to have to side with Dan this time in terms of the energy and crypto market. I do think crude is going to be a bit more cyclical, as he was saying, and Bitcoin has more potential. So I'm on him on that. I feel like we do see a bit of a pullback, as he was saying, on the easing of the supply bottlenecks and constraints that we've seen, whereas Bitcoin, technically for me, has a lot more potential. This is going into the daily chart here. I have to say there have been a few headlines out in the last few days about cryptocurrencies. We've seen payment platforms, payment networks talking about offering Bitcoin to their clients. We've also seen speculation about China coming back on their clampdown on Bitcoin mining. There's even been Elon Musk confirming his holdings of cryptocurrencies over the weekend, and Bitcoin was, of course, on there. So that's obviously what's been going on recent days. But the reality of it is that cryptocurrencies have been outperforming for the last month or so, regardless. And I think this is because they've been taking advantage of these displaced funds from weakening equities. So in a way, they've been the face of stagflation. We talked about this already. And I feel like cryptos have been able to attract investors that are looking for higher returns, given that stock markets remain at all-time highs, but the short-term outlook is quite uncertain. So I think in terms of what's presented to us here, that's why I believe Bitcoin has a lot more potential right now than in terms of crude and all that. If we look at the current chart, I mean, Bitcoin's been impressive, a 50% rise since the beginning of the new quarter. This obviously, to me, has a lot to do with FOMO. People see Bitcoin rising, people want to get in there, they don't want to miss an opportunity. So I expect momentum to build further. It's not unusual to see some consolidation around current levels as we're seeing. And I think it's also a good way for it's a healthy way for more momentum to build. And I feel like buying the dip, as Dan was mentioning, is the way to go around this. So for me, if we stay above 57,000 over the next few days, I see 70,000 over the next few weeks.
And I think a lot of people in your camp, Melton Demers, thinks 100,000 by the end of the year. You mentioned it's not unusual. Great song by the great Tom Jones from Wales, I believe. But I digress. You've also brought with you, I love this, a differential chart. So this is US 10-year against dollar yen. Fascinating. We've brought this before, something that I hadn't seen, but now something that I look at almost on a daily basis. Can you speak to this?
Yeah, I wanted to bring it back because I presented this 2 weeks ago just to kind of show how to trade kind of the dollar and a dollar pair into US CPI release that we saw 2 weeks ago. And as you were mentioning, you were saying that you see rates grind higher, Guy, probably to 177. So looking at this chart, if you are trading a dollar pair with these rates going higher, the only way you can really say dollar yen is going, it's going higher, right? Because of the way it's been moving. So if you are effectively thinking that all these inflation pressures is going to send yields higher, and especially the yields on the 10-year bonds, then essentially dollar yen is going higher. And it's going to be quite central bank heavy from here on as the currency pairs that we're going to be looking at. But big banks that are coming, we've got the BOJ on Thursday, and we've got the Fed next Wednesday. And these rate differentials are only going to start to get wider and wider as we see possibly the Fed diverging into a more hawkish stance, while the reality is that the Bank of Japan isn't really going to move from where they are, like they haven't been able to do in the last few years. So this is definitely a pair to trade this. If we go to the next slide, it's actually a slide of pound yen. Now, again, I bought this 2 weeks ago. Very interesting setup. It's actually crossed above those February 2018 highs. That was the target I was looking at last week. And I feel like this is a great way to also trade the Bank of England meeting, which is next Thursday. So very intensive few days and week ahead of central bank meetings. And I think the fact with the pound is that expectations about interest rates in the country have gotten out of hand. We saw Bank of England Governor Bailey say over the weekend that the Bank of England will have to act to keep liquidity and to keep inflationary pressures on lid. But expectations have led to the pound being overly hawkish, I think, in its positioning. So it's kind of drawing back into what you guys were saying earlier. Do higher UK interest rates slow down growth, or is it a good sign for the economy? And I think when we're facing a possibility of stagflation that markets are concerned about now, where we have stagnant growth and higher inflation, are interest rate hikes going to help? Or is it just going to show, the lack of central bank intervention in the previous year? So for me, if you want to trade a pair going into the Bank of England meeting, this is probably the trade you want to do. And just seeing how this pair has behaved lately, it's definitely a good way to trade. And I feel, do you see any more upside in the pound, given how highly hawkish the markets are on the Bank of England, and it's highly unlikely that some of the more dovish members like Tenroro will actually move to the hawkish side. So that's
I think, No, I think it's fascinating with the bank. This is obviously Bank of Japan being the consonants, they don't do anything, and the wild card being the Bank of England. So I think this is a really interesting chart. The next wild card comes in the form of the Bank of Canada, and we'll see what happens here, because a lot to me is riding on US dollar Canada. I mean, it's a really interesting commodity play as well, but there are just a lot of different forces at work with dollar Canada right now.
Yeah, I think dollar CAD is definitely overstretched to the downside. And if you look at the chart, there's been a lot of resistance around this 124 area, but we have seen a couple of retests in the last week or so. And as you guys were mentioning just a few minutes ago, the more you pressure a resistance, the less it's going to be effective. And this is kind of what I'm seeing here. So does the Bank of Canada play this pair higher? And how could that happen? Again, we've got a similar situation as Bank of England. So we are expecting the Bank of Canada to cut their weekly purchases from, I think it's currently at 2 billion Canadian dollars. They're expected to cut it at 1 billion Canadian dollars. But that's as far as they're going to go, I think. So again, markets are very hawkishly positioned for this. And is this small reduction in purchases going to be enough to satisfy markets when you have to think that this is already fully priced into the pair? So are they going to fall short of market expectations? I think the bank said that they won't start hiking before I think the end of 2022, whereas we've got interest rate markets pricing in a hike as early as the first or second quarter of 2022. So again, we've got this rate differentials between what the market expects and what the bank is saying, and how is this going to affect the pair? And I think for me, given what the Bank of Canada is possibly going to be able to deliver, isn't going to be enough to satisfy this market expectations, and we probably see dollar CAD moving higher.
A couple months ago, Chris Vecchio, your colleague, came on. He talked about the potential for New Zealand to raise rates. He happened to be spot on. I mentioned them because their neighbor doesn't seem to be. I think basically the Australia, they're going to tell you that they're probably a long ways off here. So U.S. dollar against the Aussie here is really, really interesting, I think.
Yeah, again, we saw this with, as you were mentioning, the Bank of New Zealand. They were ready and primed, and they said they were going to, start reducing all these monetary stimulus. And then we had a spike I mean, a very small spike compared to what we've seen in the US and the UK and in Europe. They had one case that then led to 20 or 50 cases, and they decided they weren't ready to do that. And that really hurt market expectations. And it's kind of now, are we in the same situation with the Aussie dollar? Again, there's a big divergence between policymakers. They've said repeatedly, and it's highly likely they'll say this again next week when they meet on Tuesday, that they don't expect any rate hikes before 2024. And then if you look at market expectations, I think there's 100 basis points of hikes priced in before the end of 2023. So again, we've got this big divergence between what banks are saying, what markets are saying, and how does this play into, again, a pair that's overextended in this case to the upside. So the dollar has been underperforming these high yielding and commodity linked currencies recently because of the move in energy prices and the move in commodity prices. And what does that mean for them when the banks come out and possibly disappoint? And this is what we're kind of playing in with this week.
Apropos of nothing, and since we're speaking of New Zealand, two of the most frustrating fruits for me are both the pomegranate, which has nothing to do with this, and the kiwi, which has everything to do with this. But Daniela, thank you so much for joining us. I know you're shaking your head in disapproval, but that's fine. Everybody else seems to do that to me as well. So thanks again for being here. Dan Nathan, wax poetic before we get on out of town.
All right, Desert Island guy, pomegranate or Butterfinger? What are you doing here?
Like what? Yeah. Really?
Really?
Yeah, absolutely.
Oh,
absolutely.
My goodness. I mean, I guess it's a bit healthier, especially if you're trying to keep your shape on a desert island and waiting to be rescued or something like that. All right. Well, listen, man, that was awesome. I mean, Daniela literally just took us on a whirlwind trip around the world of currencies. She's the bomb here. That was great. Listen, on the equity front, I'm just not I love buying breakouts. Okay, that makes perfect sense to me. But after such a big move, after such a big ricochet in the equity markets, I just don't see it as that sustainable. We just use that term back and fill on a number of different charts. That's how you kind of build momentum for meaningful breakouts. I don't like straight line up here, so I would expect a little back and fill, maybe towards those breakout levels and some of those things that we talked about that are a bit extended right here. So to me, as we're getting in the meat of Q3 earnings season, if all of those big names that we started out talking about, that Carter talked about, were to go down together, you're going to have a nice opportunity to get back in the equity markets there, guy.
Well done on the Butterfinger front, although that is a lousy candy. But I want to thank our guest, the great Daniela Sabine Hawthorne. Follow her on Twitter. She's a market analyst with IG. And I also want to thank our presenting sponsors for this week's macro setup. See how I take it down a little bit? Because this is important, Dan. I want to thank IGUS, one of the fastest growing forex dealers in North America. North America, of course, being the Etats Unis here in Canada, as you know. And of course, our friends, Dan, at Open Exchange, because what do, Dan? They manage virtual meetings that what?
That matter, guy down.
That matter for the top companies around the world. We will see you next Thursday when, believe it or not, it will be November. Letter X for you commodity geeks out there. Later.
See you next Tuesday. Guy Dami.
Tuesday.
It'll still be November, though. How's that? All right. I'll see you Tuesday. Thanks, everyone.